evening, Sanjeev ji. Prashant, hi. Yash, hi. Good evening to everyone. Uh, can you confirm if the audio quality is all right? How about you guys? Can you hear me like this? Kitna chal jayega? Some reason my audio is circling back to me. Yeah, audio is good, but my audio is circling back. Okay, now it's done. All right. New subject today. Derivatives. Are you excited? Yes. fake excitement looks like a fake excitement on your face. Yes. पढ़ ही लेंगे, पढ़ना ही पड़ेगा. Do you remember your basic stuff of level one derivatives? Call options ले लिए. Nice. I'm completely ready. Call options ले लिए. I'm ready to lose my money. लग गए दीप भाई. Yeah, long call profit unlimited. You know, I'll tell you what, call options are big scams. You know, because especially scams for students, because everyone who learns options for the first time, उनको at some stage in their life, कभी ना कभी वो खुजली बचती है. At some stage of life, they feel like I should buy call options and I should get unlimited profits. How many of you have lost money buying options, by the way? Give me just raise your hand. Everyone. Burned capital, lost once. Me exception, never did options. You're not a true finance student, Rachel. If you've not lost money on options, Lakshya says a lot. I've lost insane amount of money. Like I made good money at the beginning, but that's, I think, beginner's luck, right? When you start trading, and at times, I think stupidity helps you. You know, being stupid at times is a good thing. Yeah, the lower you know, better. You know, you're like, I'm going to buy call option, and I'm going to buy that call option that will give me maximum profit. I used to buy call options. So what my strategy used to be when I started, you know, back in the days, 2006, 7, watch this guy on CNBC, Udayan Mukherjee. I was a big fan. I don't know if you guys know Udayan Mukherjee. So Udayan is a poster boy of Indian bull markets. Okay, so Udayan he was like the main guy on CNBC. Like today we have Sherin, we have Lata. I don't know if you guys watch CNBC. So Udayan was like the main guy there. And every word that used to come out of Udayan's mouth, people used to listen to it very carefully. In fact, I remember I've seen one video at the peak of the bull market. Udayan had traveled somewhere in Ahmedabad, and he was treated as if he's a Bollywood star, like a celebrity. Uska satkar वगैरह हुआ था. And the reason why people used to love him so much is because he was the face of television, face of CNBC, Indian stock markets, at one of the best bull markets we had in the country. 2005, 6, 7, crazy money. Everyone made money. So I started my career, like trading career, or my trading adventures in those days. You buy something random, thinking you're very smart, wo upar jata raha because the markets were like that. You used to feel like, you know what, I've found out something. I have a secret sauce. Main bahut hi shana hu. All those feelings come to you, and then after a while market सबको अपनी औकात दिखाता है. Yes, it was fun. But see, this level 2 derivatives I personally enjoy. He also has his own channel, right? Watched his few videos. He's with India Today group now, Valuation. Sudan now. So what I think what Udayan did, again off topic, this is a derivative class, but I'll quickly tell you what Udayan did is he quit CNBC, and you know it was a tough, because imagine you're good at what you do, you're being loved by people. At the peak of his career, he quit CNBC. He went to some place in Uttarakhand or Himachal, and he lived in mountains for about 10 years. Yeah, so he just like quit cold turkey everything, and he went there, and I think he studied, read books, and I don't know what he did. But 10, 11 years, he was completely out of market, right? And like people from my generation miss him. We used to love that guy. He was a little, conservative type of a. So especially amidst bull market, very few people have courage to say, be cautious, be reasonable. He was one of those guys. But people at times also call him unnecessary pessimist. So you can have your own views. Very recently, it seems he's joined back. I've seen him doing some videos on India Today or some other Business Today or some other news channel. But apparently, he seems to have negotiated that he would live in London now. So from Uttarakhand, from one UK to another UK. And I'm sure, and he deserves it. I'm sure he must be paid very well. And he had that kind of a fan following. So anyway, so derivatives. So see, level 1 derivatives was, just so the way to think is, imagine there is a small tekdi, like a small hill in Pune, right behind where we're doing this class, and compare that with a large mountain range, right? Something like Annapurna, Karakoram, Himalayas, right? So a large mountain range versus small hill. So level 1 derivatives was just an introduction. There's nothing in level 1 derivatives. But level 2 derivatives, you do get your hands dirty. Okay, it goes really deep and it becomes really, really intense. At some sections, I feel they've done a little too much, right? Especially when we go to options. We would learn Black-Scholes, which is nice, but then we would also be learning this model on, black model, and then options on currency, and that's where it gets really, really technical, but it's fun. We're going to have a great time doing this. My strategy is this. I'm going to start with the first heading, which is valuation of forward commitments, pricing and valuation of forward commitments. We'll start with forwards. Then we'll do a little bit of futures. Then we will go to swaps. So we'll finish the whole forward commitment in, next 2 to 3 sessions. And after forward commitments are done, then we'll go to options. Start with basics, put call parity, and then slowly build up from there. All right. So with this background, let's start. If you like doing numbers, you're going to have great time doing this. What is this? Yep, you know it, right? It's there in the basic videos. Yeah, so it's a nice fancy shopping street. And let's say we have a character on the street. Who wants to be that guy? इसको बनाते हैं दाढ़ी वाला. आपका क्या नाम है? स्वराज. So Swaraj, I wish. Okay, let me show to the class who Swaraj is. Can you do it? Okay. Swaraj will come on the other video now. We're streaming this on YouTube, by the way, Swaraj. So, आपका video on करना. Yeah, no. Wait. We're showing Swaraj to you first. Yeah. Swaraj, smile कर दो. No, I think your video is not visible there on the screen. Swaraj nahi dikh raha hai. You see it from my computer. Okay, here we go. Swaraj, just say hi. Can you see Swaraj now? एक बार हाथ उठा दो यार. Yeah, okay. This is Swaraj. If you want, I'll post a picture of him. Arpana says shy guy. Arpana, इधर आओ, मिलो उसको, आपको समझेगा कितना shy है. All right, so here's my screen. So this is a shopping street. Swaraj is chilling there. Yeah, all right. Looks like Swaraj now. So Swaraj is going there. The first thing that he sees here is he sees an advertisement of a bank. Bank says if you'd like to borrow or lend, you can do it at 10%. Then he walks a little bit further. He sees a gold shop. And the gold shop says if you'd like to buy gold, you can buy it for a price of 100. Then Swaraj walks a little bit more. And then he sees an exchange, like a OTC exchange. And OTC exchange says, if you'd like to do a 1 year derivative on gold, a 1 year forward contract on gold, forward means you have a right and obligation to buy, you can do it at a price of 150, right? So Swaraj is observing this data carefully. And suddenly he remembers his CFA level 2 class. And he figures, you know what, it's a great opportunity for me to make some money out of this situation. Swaraj, how are you going to make money here? In fact, you know what, let's ask someone online so it gets recorded. If anyone attending online knows what to do here, just raise your hand and help us understand, please. Come on, any one of you knows how to make money out of this situation, please raise your hand. All right, Mr. Jatinder.
Hi, Utkarsh. Good evening. Am I audible?
Yes, good evening. Just give me a minute, Jatinder. Can you listen to YouTube video and see if this is being captured? Because I think if it doesn't... Jatinder, say something.
Hi, good evening. Yeah.
Bole so Nihal, Sasya Kal.
Vaheguru ji ka Khalsa, Vaheguru ji ki Fateh.
Okay, fantastic.
Excellent.
Good. Okay. Yes, so Jatinder, what do you do today?
Okay, so Swaraj will borrow money from the bank at the rate of 10%. And
so borrow. So wait for me. I'll write it parallelly. So borrow 100 today at the rate of 10%. Yeah. All right. What do you like? What do you do next?
Then he will buy gold for that.
Okay. So buy physical gold. Keep it with you. Of the whole 100. What next?
And then after 1 year, he'll sell the gold for 150.
We're missing something.
Yeah, maybe he'll kind of enter into a forward contract of 150, forward price of 150, something like that.
So long side or buy side? Should he be on the long side or should he be on the buy side?
Short. He will sell forward.
That's correct. Yeah. So he'll enter into the short side. Yeah, short side means you have a right and obligation to sell.
Yeah.
And after 1 year at a price of 150. So he does his derivative, he signs it. There you go. So today's obligations are over. What happens after 1 year?
Yeah. So he will he will have money of 150 and he'll pay back 110 to the bank.
Correct. So he'll take gold with himself. And then he will execute derivative contract, which allows him to sell gold at 150. See, here's an important thing. Why is it an arbitrage? For any arbitrage, there are two conditions. Number one is you do not invest a single penny from your pocket. खुद की जेब से 1 रुपया भी नहीं लगाना है. We don't invest anything from our own pocket. So here we are borrowing, we're not investing anything. Second condition is there should be no price risk, which means it shouldn't matter if underlying asset changes. So 1 year from now, we don't care what's the price of the gold in the market, whether gold is 70 or 200, doesn't matter because we have a right to sell at how much? 150. So gold ka jo bhi price hai, whatever is the price of the gold, we will be able to sell at 150. So therefore he will collect cash or receive cash of 150. Once he receives cash of 150, Jatinder, what do you do next?
Yeah, so he'll pay back 110 to the bank, and with 40 rupees, he'll enjoy vada pav, maybe.
Correct. So he'll repay the loan of 110, and
Yeah.
then he's left with profit of 40. That's like your arbitrage. If this question shows up on the exam, the answer is not going to be 40. The answer is going to be present value of 40. Okay, so the answer on the exam is going to be 40 divided by 1 plus 10% raised to 1.
Yeah.
So that will be what, 36? About 36, somewhere in that ballpark. That becomes your arbitrage profit. And what is this type of arbitrage called?
This is maybe.
See, the trick is to how to figure out which arbitrage we're doing. Are we going to keep the gold with us for 1 year? Yes, that's called carry. Carrying the asset with you for the whole year. So this is cash and carry. So we took the cash and then we are going to carry the asset the whole year. So this arbitrage is referred to as a cash and carry arbitrage. Right? Cash and carry arbitrage. Easy? Okay. All right. Thank you, Jatinder. Appreciate you coming in and the vada pav thing. All right. Let's quickly revising. There was an arbitrage opportunity here because the forwards were mispriced. Right? In this instance, the correct forward price should be how much? 110. Why? Because the formula for forward price is spot price into 1 plus RFR raised to N. So 100 was the spot price today. 10% was the RFR. Now I call that as a bank rate, but it's supposed to be RFR. So 1 plus 10% is 2. So it should be 110. Because forwards were overpriced, instead of 110, they were at 150. We did cash and carry arbitrage. Because forwards are overpriced, we're selling forwards. We are on the short position. So borrow 100, buy gold, enter into short forward contract. After a year, execute your forward contract, sell the gold, receive 150, repay the loan, keep that 40 for yourself. All right. Step number or the other side of the arbitrage. Again. So this is Swaraj. Now Swaraj is on a different street, and this time around, the first thing Swaraj sees is his friend's house. Friend's house. When Swaraj goes to friend's house, he spots that there is some gold kept there in the house. Then step number 2, Swaraj walks a little bit further on the street, and Swaraj spots a gold shop. Gold shop says, if you'd like to sell gold, you can sell it at a price of 100. Then he walks a little bit further and he sees a bank. And bank is advertising, if you'd like to borrow or invest, we'll give you 10%. He walks a little bit further and he sees a OTC exchange, forward exchange. And there he says that 1 year derivative is available at a price of, let's say 90. All right, so that's the forward price of the gold. Now we need to exploit the arbitrage. Now I want someone from the audience again to raise their hands and help me figure out how this arbitrage can be exploited. Come on, anyone who feels they know how to exploit this arbitrage? Just raise your hand, talk to me. All right, Santosh, just unmute yourself. You should be able to speak.
Yeah, hi, sir. Are you able to listen?
Yes. Yes, Santosh.
Yeah. First, sir, he will borrow gold from his friend.
Okay.
Mm.
We are
Then he
supposed
will sell that gold to the gold shop at 100.
to borrow gold from friend. Okay,
Yeah.
and here we are going to assume that your friend is nice enough
Yes,
to
yes, very nice.
borrow gold. Then step number 2, what do you
Then I will sell that gold in that gold shop at rupees
you're,
100.
you're saying borrow gold from friend and then usko bech do.
Yes, correct.
ये संतोष का नंबर ब्लॉक करके रखो सब लोग. Sell gold at the gold shop at 100. Fair enough.
Correct.
Now, what do you do with that gold?
Yes, then that gold I will invest. Sorry, I will invest that 100 in bank at the rate of 10%.
Invest 100 at the rate of 10%. Okay.
Yes,
What
and
else?
also I will enter into the forward long contract.
Long forward contract, which will
Yes,
give you right and obligation to buy
correct.
at 90 1 year from now.
Exactly.
Okay. What do
After
you do?
1 year, I will receive 110 from bank.
Mhm.
Then from
Receive
110, yes, and then from that 110, I will buy that gold at 90.
Buy gold at 90 because you have a derivative contract that allows you to buy it at 90. So
Correct.
buy gold at 90. Then what do you do?
Then I will hand over that gold to my friend, and the rest money is mine.
Are you not forgetting anything? At least thank you to bol do.
Acha, okay.
Return gold to the friend.
Yes.
Return gold to the friend. And then step
And the
number
present
4.
value. Yes. And then the rest money is mine. And if you
Yes,
convert that into present value, then present value.
correct. So that arbitrage here is turning out to be 20.
Exactly.
The present value of that will be 20 divided by 1.1. So about close to 18. So this type of arbitrage is called what?
It's
Reverse
reverse
cash
cash and carry. Yeah.
reverse cash and carry, right? And these two steps, which is borrow gold from a friend and then sell it in the market, what do we call this?
Short selling.
Correct. These two steps in market, we call them a short sell. Now, you don't borrow from your friend, though it will be nice if you can do that. But in practice, you borrow from whom? You'd borrow from whom? Sorry, auntie? You'd borrow that gold from whom?
Broker.
Correct. You'd borrow it from your broker, right? So if you want to short sell something, you're borrowing it from the broker and then you're selling it. And when you return that gold to your friend, that means to your broker, what is this called? Returning gold to the friend, what is this step called? Buying it back. Yes. We have a name for this step. Correct. This is called as a short cover, right? And again, in practice, this is not going to be free. It's not that the friend is or the broker is going to give you free of cost. There will be certain charges for it. But in this theoretical construct, we're going to assume that there are no charges. Okay, so this is a theoretical arbitrage. This is called reverse cash and carry. Now, why is that arbitrage here? Because your forwards are undervalued. What's your theoretical no arbitrage price? 100 plus 10%, 110. But because the actual price is less than that, actual price is 90, we will say the forwards are undervalued and therefore we're building a long position, we're buying them. Is it okay? So if the forwards are overvalued, you do cash and carry. If forwards are undervalued, you do reverse cash and carry arbitrage. All right. Now, those of you who would like to ask any questions or queries here, you can raise your hands now and ask. If there's anything that's not clear, anything that you'd like to ask, feel free to ask. Okay. All right. I'm assuming that you're okay with this. So let's start doing some numbers now. I'm going to start low and then slowly increase the level. All right, here we go. Example 1. Spot price of an underlying asset is 100. Risk-free rate of return is risk-free rate of return is 12% per annum. The वो प्रियंका को आंसर करना एक्सेल फाइल. Expiry is let's say 6 months. What would be a no arbitrage forward price? Chat box. All right, so you'll say no arbitrage forward price is equal to spot price of 100 into 1 plus 12%. It's 6 months, so that's 6 by 12, half of the year. So that will give you 105.83. Is it okay? Easy, right? All right. Now, this is called what? Price or value? This 105.83, is this price or value? This is price, right? This is locked in. It's a part of your agreement. What is the value of a forward? Profit or loss. Value for forward is profit or loss that you make. So let's explore in example 2 if we can do that. Let's say the spot price is 200. Risk-free rate of return is 8%. I'm using the word expiry. I should be using the word maturity with forwards, right? So maturity is 91 days. You can use an actual by actual day count convention. Actual by actual day count convention when you're doing the calculations. And question number A, calculate no arbitrage forward price. That will be easy. Do it up to 2 decimals. That's all right. Question number 2. If spot price after 30 days or after 21 days, if spot price after 21 days is 240, then determine the value to long position. Determine value to the long position. Start. Done. How much is the value? 39 point something. Okay. How about you, sir? Value nahi aaya. Price? Okay. All right. Let's do this together. It's easy. It's how to do it. Step number one, you just figure out the forward price, the usual formula, right? So forward price will be 200 into 1 plus 8%, but we're using an actual day count, 91 days. So we'll use 91 days divided by 365. That's it. That's what actual means. So how much does it turn out to be? 203.97, 87. So 203.87. That's the subpart A of the answer. That's easy. Now let's do subpart B. All right. Now in subpart B, here's what you want to do. And look at this carefully. Get this right the first time, then it will become very easy. There are at least 3 different ways of solving the subpart B to calculate value. I will show you all the 3. But throughout this class, once I show you all the 3, there's only one that we're going to use. So for this question, I'll show you all the 3 ways of doing this. All right. So here's what we're going to do. First, draw a timeline like this. This is day 0. This is day 21. This is day 91. Okay. This is today. So we're trying to value the contract today. Today the spot price is 240. Remember, we are trying to value from the long side. And we have already locked in a price. What was the price? The previous price, 203.87. We have a long position here. When we started out, the spot price was how much? The spot price was 200. Okay. Now here's a method 1. Okay. What you do in method 1, in fact, I'll take screenshots of this. Just give me a minute. All right. So here's your method 1. From a computation perspective, it's easiest. What you do is take this 200 forward for 21 days. That's it. Kuch bhi mat karo. Just take 200 forward for 21 days and then take the delta. Let's see if that works. So 200 multiplied with 1 plus 8% raised to how many days? 21 days. So raised to 21 divided by 365. Tell me how much is coming to. 200.88. All right. Now take the difference of 240 and 200.88. Take the difference of the two. How much? 39.12. Is that matching with your answer? That's your answer today. Easy? Yeah. It's the easiest method actually, but we're not going to use this. It's nice, it's easy, it's fast, but we will not be using this. Let's look at method number 2. Method number 2. Now here the forward price is 203.87. Bring this forward price backwards for 70 days. Okay. Why 70 days? Distance between 91 and 21. So from a calculation perspective, it will be 203.87 divided by 1 plus 8% raised to 70 by 365. 70 by 365. How much is this? 200.88. Is that correct? Now take the difference between 200 and 200.88. Mat karo, kiya na? 200.88 and 240. What will be the difference? 39.12. That's your answer. That's the second method. So you can go from 0 to 21. You can go from 91 to 21. Either ways, you end up getting the same answer. The method that we will be using the class is the longest of the three methods. Okay, but it's a very versatile method. And the reason why we need this, and you learn this, as we progress, we will start doing some complex valuations. We will do dividend yield, we will do continuous compounding. The beauty with this method is if you learn to think it like this, you would not get any questions wrong, no matter what type of questions is thrown at you. So what you're going to do in this method, or what is this method called? This method called is make a phone call method. Okay, just some random name that I made up. Make a phone call method. Now, what's a make a phone call method? So, and this is actually how it happens in practice as well. And that's why I'm insisting on using this. That you would call up your dealer. In practice, you don't call, but you have databases that will take the input. But you call up the dealer and you tell them, see, I entered into some derivative, 21 days ago. Now, on the same underlying asset, I would like to enter into a new forward contract for a period of 70 days. What will be the price? So dealer will say, okay, hang on, let me do the maths. So maths will be 240 into 1 plus 8% raised to 70 divided by 365. So the new forward price that the dealer will give you will be how much? 243.56. So dealer will tell you, okay, the new forward price is going to be 243.56. What you will tell dealer is, you will say, okay, on the new forward contract, I would like to build an opposite direction, an offsetting trade. So if I had a long on the previous trade, I would like to build a short on the new trade, offsetting trade. Okay. So what this means is, it means 70 days from now, you're going to buy at 203, you're going to sell at 243. You are going to make some money there. The difference between the two is going to be your profit on expiry or on maturity. You're buying cheaper, you're selling expensive. Are you actually doing it? No, this is a what if scenario. What if I do this? Right? This is called mark to market process. If I do this, how much profit I make? Difference of the two, how much is that? 39.69. This is going to be your profit on the day of expiry. This is how much you make on expiry. But obviously, we want to figure out the valuation today. So we're going to discount this backwards for 70 days. All right, so that's going to be 39.69 divided by 1 plus 8% raised to 70 by 365. And that will again give you 39.12, which is your answer. It's a lengthier method because it requires one step extra. You take the forward value, you take the difference. The only step extra it requires is you need to take present value here, right? But the reason why I recommend this is because of the versatility of this method. This method can be applied, and you'd see that today. It can be applied to dividends. It can be applied, to continuous compounding process. It can be applied to currencies. It can be applied to cheapest to deliver bonds. It can be applied in a variety of different situations. All right, so there you go. This is your valuation of the forward contract. Is everyone comfortable with this? This is mostly repetition of level 1. If you studied level 1 together, we did a lot of these examples. All right. Should I scale up the level a little bit? Jatinder is saying he entered into opposite contract. Yes, Jatinder. This is a what if scenario. He's not actually doing it, or the trader, she's not actually doing it. It's more of what if. What if we enter into opposite side, then the delta of the two is my profit. All right. Then we will do the next example. Example क्या number है 3, right? Example 3. Let us say now the underlying asset is S&P 500. Underlying asset is S&P 500. The risk-free rate of return continuously compounded per annum. Risk-free rate of return continuously compounded, let us say, is 7% per annum. Dividend yield continuously compounded is 1.6% per annum. Question number A, calculate no arbitrage forward price. Assume contract maturity to be 182 days. Use actual by actual convention. No arbitrage forward price. Question number 2, if after 32 days, S&P 500 is trading at, I forgot to give you the original price, no? Original price 3,200. If S&P 500 is trading at 3,350, then determine the value to the short position. Now wait a minute, let me finish this. Now the RFR has changed. RFR has become 6.5% per annum. Dividend yield is same. Dividend yield is 1.6% per annum. Both of them are continuously compounded. Start. So figure out value and figure out price. You have 5 minutes, otherwise I'm going to solve this. All right, let me show you how to do this. It's actually very simple. It doesn't even take so much of time. Once you learn this, you find that it's very, very easy. The first thing you need to know is dividends will reduce your no arbitrage forward price. Did you know this? If you receive dividend, it will reduce your forward price. In fact, any cash inflow that the underlying asset gives you reduces your forward price. Tell me why. It's a benefit, right? So benefits are subtracted, correct? But why? Level 1 mein padha tha. But why? Why do we deduct benefits? So we are not going to get those benefits again. Why not? A company pays dividend every year. Huh? I've used what? When I receive dividend, why should my forward price go down? Forward price should go up. Company paying dividend, stock price goes up, no? Stock price goes down. Every time I see in the market some company announces dividend, stock price goes up. You're saying stock price goes down? क्यों? Book में लिखा है. Correct. So the way you want to think about this, theoretically, when a company pays dividend, think of it as ownership of a company's stock is nothing but ownership of a piece of a pie. So when a company pays dividend, वो cake काट के आपको खिला रहा है. So the value of the remainder of the cake is lower, right? They've just cut a piece out of it and given to you. So the value of the remainder pie which is left is lower. So when a company pays dividend, they're paying the cash of the company will reduce, the assets of the company will reduce. So in theory, the stock price will fall. And why the stock price goes up in the market is because stock price will fall, keeping everything else constant. But every time the company pays dividend, automatically sentiment and all those variables play out. So in practice, if it's a smaller amount of dividend, stock price wouldn't fall as much. But if you see some of the companies where they pay large ticket size of dividend, for example, ITC, right, where a dividend yield could be as high as 3-4%. So when the amount of dividend is higher, you will see the impact on the stock price. Stock price will reduce a little bit. There is some technical tax adjustments there, which we will learn in corporate finance class. Okay, that's there as a part of the level 2 syllabus. But right now, a very simple concept for all of you. If there is any sort of benefit coming from underlying asset, that's going to reduce the forward price. Now, how do you calculate a forward price here? Easy calculations. A no arbitrage forward price is equal to spot price into E raised to R minus Q adjusted for T. That's it. This is your continuous compounding formula. R is your RFR, Q is your dividend yield. Okay. So calculations will look like this. It will be 3,200, which was the original spot price, 3,200 multiplied by E raised to. What's the RFR? RFR originally was how much? 7%. 7% minus, what was the dividend yield? 1.6%. 7% minus 1.6%. And this expiry was 182 days. So it will be 182 divided by 365. Let's do the calculation together. I've seen some candidates have this strange fear with continuous compounding. Maybe a backlog from school days. At least when I did, when I was in school, they used to give us logarithm tables. Log tables aate the. This is a natural log, right? So we used to go to those log tables and kya hai kya kabhi? And then nahi, you must have gone to expensive schools. So you don't need I conversion here. Oh, you have fear. So now learn this. You would realize that in fact, continuous compounding is very easy to deal with compared to discrete compounding. बहुत ही आसान है. So you do this with me. I'll show you how to do this. All that you need to do is first solve for this exponent. Okay, so 7 minus 1.6. 7 minus 1.6. How much is that? 5.4. Then press the percentage button. So it becomes 0.054. Is it there on your screen? 0.054. Multiply with 182 divided by 365. So that's 0.02692 something. That's your exponent. Now we have to take base as E, right? So we have a screen by 0.026. Now press second and then press e raised to x. Second e raised to x. So it will give you 1.02729. And then just multiply that with 3200. That's it. So 3287.33. That's your no arbitrage forward price. Okay. Now, those of you who kind of feel scared with continuous compounding, let me show you something cool. Okay, just for learning purpose, let's say that I give you an interest rate of 5%. Okay, and I tell you present value of 100, and I tell you time period of investing is 1 year. In one case, we do discrete calculation with annual compounding frequency. In second case, we do continuous compounding calculations. Okay, how would you do it? You will say 100 present value multiplied with 1 plus 5% raised to 1. Is that correct? So that becomes 100 multiplied with 1.05. That becomes 105, right? When you're doing continuous compounding, you do 100 into e raised to 5% into 1. That's it. That's how it changes. Now, the interesting thing is, let's solve for this sum. Do this with me. 5% into 1. I mean, we don't need to do into 1, but just for muscle memory. 5% into 1. So you have 0.05 on your screen. Second e raised to x. What do you get? 0.5127. Can you compare? Do they look similar? Yes, it's the same stuff, right? It's just that you're taking an exponent as the base. That's it. And then it will turn out to be 105.127 or something on those lines. That's what continuous compounding is all about. There's nothing to it. And when you need to take present value, so here, if I had to take present value, okay, how would I do it? So here I will say 100 divided by 1 plus 5%. So this will be 100 divided by 1.05. Correct? So this will turn out to be 100 divided by 1.05, 95.238. Here what we do is, we say 100, we keep the same formula into 5% raised to 1. But when I want to take future value, I keep my exponent as it is. When I want to take present value, I just say negative. Q negative. So when your exponent is negative, iska matlab hota hai, this is same as 100 into or 100 divided by e raised to 5%. So when I move it to the numerator, the exponent becomes negative. So the way here we divide with 1 plus 5, here we divide with that number. So if you feel this is difficult, you can also divide it with it. It's the same thing. Okay. And then when I do the calculation, what will this be? So two ways. Let's do it with negative exponent. Okay. So it will be 100 into 5%, make it negative, second e raised to x, and it will become 0.95122 something. And then that becomes 95.122. That's it. So continuous compounding is in fact very easy to deal with. But a little bit of practice, that's it. We should be okay. Any practical example of when we use continuous? Everything where every asset class everywhere in the world where compounding frequency is not specified is continuous compounding. You know, for example, when you invest in equities, okay, conceptually, let's say you invest 100 into equities. By the end of the year, you have 105. How much return you want? You invested 100. By the end of the year, you have 105. How much return you want? 5%. If you say 5%, you're saying that it's a discrete event. There was one day when I earned that 5%. I'm getting returns once a year. But technically, on any asset where a compounding frequency is not specified, that asset was compounding for you the whole year. When the markets were on, when the markets were off. Every fraction of second, something was happening, right? Demand, supply, mechanics, company management, company business, whatever. So technically, real estate, equities, all these asset classes, they are fit for continuous compounding models because they are compounding every fraction of second. Every fraction of second, something is changing. Fixed income assets, we generally use discrete compounding because the agreement specifies that I will be receiving coupon twice a year. So discrete compounding is actually a compounding made for the fixed income product. For everything else, the natural compounding mechanism should be continuous. Okay. All right. So getting back to business here, everyone okay with forward price computation? We deducted dividend here. Why did we deduct dividend? Because dividend will reduce the spot price, right? That's what we've done. Okay. Now B. So for B, we again do a simple make a phone call procedure. That's why I told you it's a very versatile method. Day 0, day 182. You've already entered into a contract at 3287.33. This time around, you've entered onto which side? You've entered into short side. So you're saying I have a right and obligation to sell at 32833. How many days have passed? After 32 days. So these are 32 days. This is today. This is today. All right. Now, today, what is the price of the underlying asset? Price of the underlying asset is 3350. So what will you do now? You would make a phone call. Make a phone call to whom? Dealer. What will you say? You will say that I would like to figure out what's the price of a new forward contract on the same underlying asset, but this time for how many days? 150. How do we get 150? Difference between 32 and 182. 150 days. All right. So the dealer will do the same calculation. 3350 into e raised to. Remember, the RFR has changed. So now we'll have to use a new RFR. New RFR is 6.5%. 6.5% minus 1.6% because dividend yield still applies. But now we have 150 days as a ratio to 365 days. Okay. So let's do this math. 6.5 minus 1.6 percentage. So I have 0.049 on my screen into 150 divided by 365. I made a mistake, it seems. 6.5 minus 1.6 percentage into 150 divided by 365. Second e raised to x into 3350. I'm getting 3418. 3418.14. That's the new forward price. Now, on the previous contract, you had a short position. So on this contract, you want to build which position? Long, opposite direction. Are you actually doing it? No, it's a what if scenario. How does it happen? How is this happening in practice? If you're an investment bank, your systems are integrated with the database vendors. There will be multiple dealers quoting multiple prices. So your system will take an average of the different forward quotes you're getting. And then that average forward quote will be compared with the price at which you entered. Difference of the two discounted backwards will be your mark to market valuation. So in this case, we are buying at 3418. We're selling at 3287. Does it look like profit or loss to you? Profit, loss, profit, loss. Udhar dekh ke bolo, profit or loss? It's a loss. Why? Because you're buying at 3400, you're selling at 32. So short position in this instance is making a loss. What would be the loss? Loss on expiry will be the delta of these two numbers. How much is the delta here? 130.81. Okay. Now this 130.81, is this your final answer? No, we need to discount this backwards to today, right? Remember, we are figuring out M2M losses today. For how many days? 150 days. Now here's a trick. And look at this carefully, because if 100 candidates are writing the exam, at least 70 to 80 of them will make mistake here, and see what mistake. When I'm taking present value, I will say 130.81 into e raised to 6.5 percentage minus 1.6 percentage into 150 by 365. And remember, we have to take a present value. So this is negative. Correct? No? We don't take what? Why? Correct. Because you're not doing a forward pricing anymore. Are you calculating a forward price now? You're just discounting 130 backwards to today. So the most common mistake people will do is that they will consider dividend yield here as well. You don't need to. This is simply a present value calculation. Here in this leg, do not use dividend yield. In this leg, do not use dividend yield. That's the common mistake, because you have done two calculations so far, deducting the dividend yield, right? So the natural tendency will be to just repeat the formula. Don't do it. Here you're simply taking present value. That's it. And see, if you open CFA curriculum, they've given formulas for each of these steps. Another way of dealing with this is we can memorize those formulas. I do not know even a single one of them. But if you're a formula person and you feel that comfortable, then you don't need to remember all this stuff. Just memorize the formula, plug and play, you get the answer. But if you want to do it without the formula, then you'll have to kind of remember this small trick here, that I'm simply taking present value of future profit or loss, so no dividend yield required. Why minus sign here? Because we're taking a present value, right? So we're taking a present value, so minus 6.5. Why minus 130? Because it's a loss. Okay, so let's do it together. 6.5 percentage negative into 150 divided by 365 second e raised to x multiplied with 130.81 will give me a final answer of 127.36. 127.36 is your final answer, and that's how you value a forward contract with continuous dividend yield. Now the question is, why did we need a continuous dividend yield here? Why not a discrete dividend amount? In this example, why was continuous dividend yield given? Why there was no discrete amount? Because generally stocks, there's a discrete amount, right? You'll get a dividend of 20 rupees, 30 rupees, $10, $5. Why was there a continuous dividend yield here? Because it was an index contract. It was a contract on S&P 500. In S&P 500, we have how many stocks? You must be a genius, huh? We have 500 stocks. Hypothetically, in theory, if every stock is giving you a dividend, in a year, you're getting how many dividends? 500. How many days in a year? How many working days? 252. 252 days, you're getting 500 dividend. On a single day, you're getting how many dividends? $500 बार डिविडेंड मिल रहा है, साल में 250 दिन है, तो 4 डिविडेंड मिलेगा एक दिन में. So you will receive dividend twice a day, right? In theory, you're getting dividend 500 times, 252 days. So you're getting dividend दिन में 2 बार. So if you decide to do discrete calculations, you'll have to do discrete dividend. Discrete means a fixed amount, $10, $2, $5. You'll have to do 500 calculations. That obviously becomes very difficult. So when you're dealing with index, we don't quote discrete dividend amounts. We just quote a continuously compounded dividend yield. If it's not continuously compounded, we can always convert it to continuously compounded. Okay, so if you want to see that with Nifty, so all that you need to do is, in fact, we can look it up for S&P 500 as well. So you take any index for that matter, you should be able to see a dividend yield. So let's look at Nifty 50 in India, a dividend yield. So Nifty 50 is a broad market index in India, and let's take dividend yield of what's the latest 17th. The dividend yield right now is about 1.46%, which means if you're buying Nifty, again, you don't buy Nifty because it's a hypothetical asset, right? But if you're buying Nifty for a price of 15,293, on an average, the dividend yield that you're earning on that is 1.46% per annum. That's how these calculations work. Understood? Easy? Okay, good. Now let's look at S&P 500 quickly. S&P 500. Oh, I didn't know the dividend yield is so large. What's the median? 4.23. S&P 500 dividend yield. No, yeah, this is a more realistic number, about 1.37%, somewhere in that ballpark. So these are your dividend yield on indexes. So the reason why we had a dividend yield is because we were dealing with index. That's it. Understood? We can use it for stocks. Mathematically, it's doable, but generally with stocks, you get discrete dividends because it's not that a stock is going to pay you dividend every day. A stock will pay you dividend, it's let's say in 2 months, 3 months, 4 months. So in your financial model, you figure out that, okay, I'm expecting a company to pay me dividend 3 months from now of 20 rupees or $20. You take those $20, you discount them backwards. So with stocks, you get discrete dividends. With indexes, you will get continuous dividend. But conceptually, the treatment is same. If you have a dividend will reduce the forward price. Okay, let me see if we have any questions on the chat box here. Could you please explain which one is long or short? Okay, Darith. The existing contract is on short, Darith, because the question said we have to determine the value of the short position. Look at this. So the existing contract is short. So therefore, on the existing contract, we took a short position. So on the new contract, we build a long position. And then we take the delta of the two. If you're buying cheap, selling expensive, it's a profit. If you're buying expensive, selling cheap, it's a loss. That's it. Can you please again explain why loss got the absolute number correct, but not right on profit and loss? Okay, Niket, on the existing contract, the question said we have to determine value of short position. So existing contract we signed at 3287. We have a short position here. Short means right and obligation to sell. After 150 days, the forward price became 3418. We take an offsetting position. That means we take long. Offsetting means opposite. So long means to buy. So you're going to buy at 3400. You're going to sell at 3200. So you're buying expensive, 3400. You're selling cheaper at 3200. Difference of the two will be your loss. And then you take the loss, you discount that backwards. What is the interest rate IBs use in practice to calculate the forward price? Same, Rahul. They do use RFR. Generally, they try to match the RFR with the RFR maturity with the expiry of the product. Can you solve for stock discrete dividend? Yes, after the break. Rahul, okay. All right, cool. Great. Let's take a few audio questions. If anyone would like to ask any queries, just raise your hand and talk. Jatinder, you can unmute yourself.
Yeah, thank you. Am I audible?
Yes.
Okay, great. So bit confusion with short and long, but I assume that it will be given in exam or something like this, so should be fine. But again, I was thinking about one scenario. If you go to that timeline where we have, yeah. So when we say today, it's 3350 and I'm making a call to the broker, right? And if broker give me some bid and ask, so I think with short and long, and this will be again a further confusion, right? So just thinking how it will work.
If your question is, if instead of giving a single price, you've been given a bid and ask.
Yeah.
Okay.
And
So it's
if I'm on short, and then whether I should consider a bid price or ask, and if I'm on long, then what I should consider.
Yeah. So see, it's very easy. Generally, it can happen with currency forwards. Okay, where they can give you, which we'll be practicing anyways. But here's the easy way to think. What is your existing position, short or long? Existing derivative position is what?
Short.
Short. So offsetting position, do you want to buy or do you want to sell in the offsetting contract?
I will buy.
Buy. So if you're going to buy, you always buy expensive.
Correct.
If you've been given a bid-ask spread,
So I'll go for ask.
you're always on the losing side. The dealer is always on the willing side. So you've been given a bid-ask spread and you're supposed to buy expensive. Expensive means buy ask.
Yeah.
If you're supposed to sell cheaper. Cheaper means bid. Ask is always higher than the bid. So that's the logic you want to use. That the bank or the dealer always wins and we always lose. So we always buy expensive. We always sell cheaper in the bid-ask spread context.
Yeah, got it. Got it. One more quick question. Like in this case, we have dividend yield, so which is a benefit. So we subtracted it. Any scenario where it will be a cost which I have to add in the exponential and then continue?
Yes. There could be insurance cost. There could be storage cost, typically in the context of commodities. So we will do one example after the break where we'll have to deal with insurance, storage, and variety of different costs.
Got it, sir. Thank you so much.
Cool. All right. Great. Anyone else would like to comment for a query? Okay, fantastic. So here's what we're going to do. We'll take 20 minutes, a 20-minute break. I'm going to put on a timer. The session will remain on YouTube as it is. So those of you attending this class live on YouTube, take a 20-minute break, come back. After the break, we will do one question on discrete dividend, pricing and valuation. Then one question on commodities that he mentioned, where we have, apart from interest costs, we will have storage, insurance costs. So we'll also learn to deal with that. All right. So 20 minutes, and we can see you again. I think Mumbai, Pune, everyone is missing. Is it raining here? No. I wish it did. Very cold in Bangalore. That's nice. Cold is nice. I think I'll have to make a trip now. Massive rain in Assam. You know what? But the rains in Assamese plains are a little scary for me. Flood-like situation. Yeah, like I've been to Brahmaputra River a couple of times. It's a scary river. Like the feeling that I get every time I visit Brahmaputra is, I feel scared. It's 1 kilometer from me. Yeah. Sir, I have one F2F session in Bangalore as well. Yes, Karthik, very soon. So, have you been looking at the markets? It's been crazy, right? What do I think? I think where is Nifty here? Let's look at. I don't know. It's been more ferocious than what I originally anticipated. But yeah, you can see plenty of that. This is not my portfolio, by the way. It's a watch list, a random watch list that I've been adding. We could have a relief rally next week and again continue with the fall. That's a possibility. Everything is, but some of the stocks now, when I look at them, it looks like they're reaching to a level where they deserve, some consideration of buy. Especially certain small caps and mid caps, I think they've been beaten up quite a bit. So I'm thinking next week maybe I'll make my first purchase in this market. This week I'll be spending some time on it, but yeah, I might make my first buys in the market. Yeah. See, I don't know. Elon Musk has a big fan following, and I also like some of the things that he does. But I obviously did not like the whole Dogecoin episode. I think he had no business. That was a sheer nonsense, right? Dogecoin. That was supposed to be a joke currency. It was supposed to be a joke currency with what at one stage it reached to $3 or $4 billion valuation. It's huh? Yeah, and I mean it's just sheer nonsense what happened to. I did show you those pump groups, right? In one of the videos. it's crazy what happens in the crypto world. And I'm in the hindsight, I'm happy that I did not allow that FOMO to take over. Because I remember first time when I was really, really uh, attracted towards crypto. I had a student. He was studying in Wharton Business School at that time. This is, I think, 2018, and he was the head of blockchain committee at Wharton, like a blockchain group. And this guy called me once, and he said, "Sir, Utkarsh, घर बेच दो, गाड़ी बेच दो, कपड़े बेच दो, और Ethereum खरीदो." He was like, "Sell everything and buy Ethereum." And I told him, I confess, I said, "You know what? I don't understand what this is." So he said, "Okay, you take a couple of days, do research, and then buy." So I spent a couple of days researching it. Then after 2 days, I told him, I understand even less compared to what I think I used to understand 2 days ago. And thank God I didn't give well for the hype. I mean, because I feel if you see, you have to learn to distinguish between investing and speculation, right? If it's a speculative bet, and you're speculating, that's fine. But to me, again, to think that crypto is an asset class is a very difficult sell. It just doesn't make sense. I mean, the fundamental question on first principle I asked myself is, would I ever invest in US dollar? Will I ever say that I'm going to park 10% of my portfolio in US dollar or British pounds or Swiss franc? No, because currency is not to be thought of an asset class, right? Currency is a medium of exchange. So from that perspective, just never made sense. And I know there are some guys who are talking about Web 3.0 and saying that if Web 3.0 becomes reality, then Ethereum is going to be currency and all that. And if that happens, maybe then I would consider investing. Someone recently told me do 1% allocation in crypto. That's sheer nonsense. If I'm going to buy something, I'll probably buy sizable or not buy at all, right? Because you buy something for 1%, even if it goes up 4-5 times, that's just 4% of your portfolio. Doesn't mean anything, right? So instead, I would rather just buy something that I understand well. Okay, Divyansh has a question. Divyansh says, don't we expect more correction in equity markets given the above expected CPI in the US and Euro? As a result, macro markets are pricing in continuous rate hike by ECB and the Fed? Yeah, that's true. See, no one really knows what's going to happen in markets. So I don't know if there will be more corrections or not. And one thing that I've learned in the last 15 years is trying to time the market is a fool's exercise. And I used to be that one of those guys, right? I used to think that, I'm so smart. I used to look at historical charts of Nifty, and I used to tell myself, these guys are idiots. I will buy when Nifty is at the bottom, because when you look at historical chart, it always makes sense. It's so obvious, right? That I should have bought in 2008 crisis and I should then sell when the markets are at the peak. But the thing is, you can never time the market. So maybe we are in, couple of years of bear market. Maybe we'll have significant time correction. But if there is anywhere in the world today where if I would like to buy equities, that would be in India, because we are only large economy in the world today, which will be able to grow at 5-6%, which has investor confidence. So if not today, maybe after 1 year, after 2 years, FIIs will flock to India. And I do believe in China plus one story. I think China plus one has to work. I mean, there's absolutely no reason why China plus one will not play out. You talk to any supply chain guys globally, right? Take any industry, talk to any senior supply chain professions. We did a lot of channel checks on this few months ago. Everyone, and this was happening even before the COVID. The supply chain diversification was happening even before COVID kicked in. So every large supply chain, people were thinking of diversifying themselves out of China. And obviously out of China, you're left with very few options. You're left with Thailand, Indonesia, India is a strong candidate. So even from that perspective, I don't see any reason why Indian markets, wouldn't perform as per the expectations. So yeah, when to buy, maybe buying a little bit early. Maybe we should wait out for some time. But there's one particular stock which I feel has reached to a level where it looks attractive. It's that stock has already been in my portfolio for a while. I bought in at a slightly higher level than what it is now, but now it looks attractive. So I'll start making my first purchase. Being fully prepared that there could be 20-30% notional losses on top of it. Yes, Vietnam is strong, Indonesia is strong, but see, it's not. I think the correct way to say it is China plus, not China plus one. I think the way it's going to be going forward is these large companies, Western companies, they will diversify supply chain from China to a little bit India, Indonesia, depending on competitive advantage. That's again, your Ricardian economics 101. For example, India can do specialty chemicals really well. Look at our chemical companies. If you make a list of all the chemical companies in India, at least more than half will have history of 3 to 4 decades. Take any company in any space. You'd find these companies are like 30, 40, 50-year old. So they know their stuff really well. And that makes a very strong case for moving to India. IT has been, India's story. So IT is an attractive space. So there are a lot of bets, I guess. Even NBFC looks fantastic. Pharma looks fantastic. So selectively buying is what I think is the name of the game. So buy a little bit now. That's what I will do, not an advice, but buy a little bit now, then wait for a month, then buy a little bit more, and just keep on doing this. See, here's an interesting way to think about it. I'll give you a funny story, right? After World War II, Germany was in really deep trouble. Okay, the worst economy ever, hyperinflation, the GDP had contracted. If you were an individual in Germany at that time and you would have seen surroundings, you would have said that, it's going to take 10, 15, 20 years just to reach previous level. But Germany was able to build itself in 3 years. Within 3 years, the GDP reached to the pre-war levels. So every time you're in crisis, because there is a lot of social conditioning that happens, we feel like this is going to remain forever. What's happening now is not new. I mean, yeah, there are some new elements, right? But we've had recessions, in the history of human life. Like last 100 years, there have been so many recessions. After every recession, markets have reached new highs. Take any recession in the past and then see what happens 1 or 2 years after recession. So even if let's say this thing continues for next couple of years, but the markets will reach high in next 3, 4, 5 years. If you have that holding capacity and if you have the patience, all of us who buy in this market will end up winners if there's a 4, 5 year type of horizon. Just I think the one thing that I'm being careful with is not to buy into hype stocks. I think that's a mistake because even after the current crisis, some of the stocks are at insane valuations. Even today, there are a lot of stories in the market where, the implicit or the implied growth assumption is 30, 40% for next 5, 10 years. Right? Case in point would be your DMart, Nykaa, great companies, love them. But valuation makes me very uncomfortable. Yeah, Adanis and Ambanis, I don't touch those names. Never. No Ambanis, no Adanis. ये सब बकवास छोड़ो, स्टॉक का नाम बताओ. Yeah, no, I generally prefer to get into a business where the family is doing just one business rather than doing a concentrated set of businesses. Uh, Full disclaimer, Reliance is in FinTree's portfolio. So FinTree as an organization also has a portfolio, but that wasn't my decision. In fact, I was not very happy with that decision, but it was still taken. But yeah, I'm not a big fan of, I don't, my personal style of investing, I don't prefer any business group that is into more than one businesses. Because I look for promoter driven businesses and I want the promoter मेरी वाली दुकान अच्छे से चलाए, right? Whatever business I want to buy, I want promoter to be like doing only that and nothing else. So if I see a group trying to do too many things, that's an exit. I think only exception in my personal portfolio like this will be RPSG. There's one stock that I have, which is a big group, Sanjeev Goenka group. But then I still feel okay with it because I think the quality of management has been reasonably good, except their son. But otherwise it's been great. What do you think of buying sector ETF rather than mutual funds? Yeah, I think that could be a smart bet. So buying sector ETF and not buying mutual fund is simply saying the fund managers know nothing, right? I mean, that's what you're saying, right? If you're buying sectoral ETFs and not buying mutual funds, I mean, not buying sectoral mutual funds, you're just saying that fund managers don't understand the game really well. And that's a fair way to play it. If you're playing on sectors, that could be one way to do it. Investing into unlisted space, I've done a couple of trades in the past. I wanted to do one trade on NSE. National Stock Exchange shares have been floating in the market for a while, but the size that I was getting was really, really large. I did not want to allocate that size to NSE, so I dropped it. Prior to this, I've done few trades on unlisted space. I generally, again, see, I don't know if you guys know it. If you buy an unlisted stock, and if that company gets listed, you cannot sell that for 1 year. Are you aware of that? There is something called as the promoter lock-in window. So that lock-in window kicks in, so you cannot sell your stock for a year. So generally in markets like these, that's again, something that you want to be careful with. 1 year, I guess, Shahid, but I'm not sure. Could be 6 months. But if I remember well, I'd bought in BSC, Bombay Stock Exchange, before there was an IPO. And I think there was a lock-in for a year. So I sold them after a year from the purchase. Okay. Sharmaji bought Paytm bought after 6 months. I read news. Yeah. We should discuss about Paytm someday. My theory is Paytm is a victim of bad media, and Paytm is a victim of one of the family groups that we just mentioned. Now, this is going on YouTube, so I just want to be careful with what I say. But I think Paytm is a victim of one of the large business houses in India. And I'll tell you a very solid proof. Every time a company gets IPO, these guys are invited on CNBC, at least, reputed companies. And they're invited on CNBC, and generally, the discussion is fairly positive. You congratulate them and, you have a nice conversation. I want you to see the video when Paytm got listed. Someone was interviewing him from one of the media channels, and you look at the stupidity of the questions which was being asked. I mean, as a citizen of this country, I want to celebrate the entrepreneurs, right? And Vijay Shekhar Sharma is a legend from that perspective. I mean, whatever IPO valuation, that's debatable because he was not the only one to determine the valuation. There are a bunch of investment bankers and investors. But but we want to celebrate the entrepreneur, not criticize them for their failures, because that's how US has become great, by celebrating the entrepreneurs. So okay, all right, enough of general talks. Let's get back to forwards. Yeah, I like Kural Shah too. All right. Example number what? 4. All right. Let's say the stock price today is 250. Let's say risk-free rate of return is 10% per annum, compounded annually. Okay, that's, by the way, a standard base case assumption if nothing is mentioned for CFA exams. Compounded annually. The maturity of the contract is 1 year. Expected dividend in 3 months is 20 rupees. In 7 months is 25 rupees. Okay. So this is a discrete dividend now, not continuous. Why discrete? Because there are 2 specific dates when we're expecting dividend, one for 20, one for 25. Look at the word expected, because no one really knows what the dividend is going to be, right? So it's a more of a forecasting process. Now here, based on this, step number 1, determine what should be the price, no arbitrage forward price, which is easy. Step number 2, if spot price is 300 after 4 months, if spot price is 300 after 4 months, you need to figure out what should be the value to the long position. Okay, so this is an example of trying to value a forward contract with discrete dividend. I'll just tell you one simple trick to deal with this. You want to solve this question the way you solve regular question. You just need to take forward value of the dividend. Take dividend on expiry, and your final answer would be the future value of spot minus future value of dividends. That's it. And you apply the same logic for valuation. Figure out new price, call up the dealer, take the delta, discount the delta backwards. See if you can do it. You have 3-4 minutes, then I'm going to solve this. All right, let's do this together. Here's how we're going to do this. Any questions like these? Starting point is to build some sort of a timeline here. So time 0, your expiry is coming in 12 months. Right now, the spot price is 250. You're expecting 1 dividend in 3 months, 1 dividend in 7 months. All that you have to do is you have to take this amount forwards for 5 months. Okay, take it on expiry. You need to take this amount forwards for 9 months. Again, take it on expiry. And take this amount forward for, let's say, 12 months, right? 12 months. If this is A, and if this is B, and if this is C, then your answer is going to be A minus B minus C, which is nothing but future value of the stock minus future value of dividends. All right. So you guys, please help me with A, B, and C number. How much is the A? 27. Okay, so A is 275 point something. I'm ignoring the decimals. B is how much? 26 point. Okay, 26. And C is how much? Okay. C is 26 and B is how much? 21.48. Okay, so 21.5-ish. Now you do A minus B minus C, and that gives you your forward value, which is how much? 227.52. All right. Now, those of you who got this right, give me a large, loud I pass on the chat box. All right, nice, good. Now, how do you handle the valuation? All right, so again, best way to do it, build a timeline. So time 0, this is 12 months. Now, the question clearly specifies that we have built a long position, right? So you don't want to be confused there. We have a long position on the existing contract. At what price? 227. So 227.52, we have already built a long position here. So this is my long position here. All right, then what's happening? So this is 0, this is 3 months, this is 7 months. In 3 months, the stock price, the dividend was 20. This is dividend of 25. Where am I today? Today, I am at 4 months. All right, so this is today. This is 4 months. And today, the stock price is 300. All right. Now, the first thing that we do is we say that this is today. So I don't care about dividends which were paid in the past. So this dividend doesn't matter to me anymore, right? I care about only the dividends that are going to come to me in the future. That 20 is already priced into this 300. Obviously, stock price must have fallen when the stock became ex-dividend. That's already been taken care of. Now, what do? We call up the dealer and we ask dealer for a new price, right? So call up, make a phone call, call up the dealer. And then what happens? You take this 25 forward for 5 months, from 7 months to 12 months. You take this 300 forward for 8 months. Why 8 months? From 4 months to 12 months. If this is your A and if this is your B, your new forward price is going to be A minus B. All right. So tell me what would be the A value here? 319.6 cent. All right. So A becomes 319.6 cent. What's the value for B? 25.60. It'll be same as what it used to be earlier, 26. Okay. So maybe it was 25.6, but you rounded it off to 26. So I'll stick to just 26. It's the same calculation, right? You don't have to calculate this again because the same number of months. All right. So once we've done these two, A minus B, that gives you your new forward price. How much is that? 293 point. Just a minute. 293.67. All right. Now, on the previous one, you have a long position. So on the new one, you want to build which direction? You want to build a short position. Right? So previous one long, on the new one, you want to build a short position. So you're buying at 227, you're selling at 293. So this is going to be a loss, right? Profit? Okay, then profit. So you're buying cheaper, you're selling expensive. So you have a profit. You have a profit of how much? 66.16. Is this your final answer? No, because this is your profit when? On expiry, right? You need to figure out mark to market. So you want to take this backwards for how many months? 8 months. So 66.16 divided by 1 plus. What's the rate? 10%. And for how many months? 8 months. So 8 by 12. So that will give you a final answer of 62.09. That's the value of your long forward contract today. Now, if I were to give you the same question for short forward, what would have been the answer? Minus 62.09. Remember, derivatives is a zero-sum game. So if I'm making something, the counterparty is losing the same amount of money. So that's how you deal with these type of questions. Easy. All right. So example 4 is out of our way. Example 5. Jatinder, if you know what you're doing, if you know the logic, you can do whatever you like. Okay. Example 5. Example 5. Now let's get into commodity space. Let's say some commodity, let's not name it, let's just call it commodity. Some commodity has a spot price. Niket, we don't have a loss, we have a profit. Loss was a joke. We have a profit. We're buying cheaper, we're selling expensive. Okay. So some commodity has a spot price of 200. Now, risk-free rate of return continuously compounded is 10% per annum. You'll have to pay a storage cost of 6 per unit. A storage cost of 6, which you will have to pay at time 0. You will also have to pay an insurance cost, okay, of 3 per unit at time 0.5. That's it. Example 5, we'll keep it. That's it. Calculate no arbitrage forward price. Calculate no arbitrage forward price. This should be easy. We have 2 costs, so you should be able to handle this relatively easier. Come on, Mumbai, what are you up to? Solve. Maturity is 1 year. Maturity is 1 year, just 1 unit, just 1 unit. Maturity is 1 year and it's just 1 unit. One year, just single unit. Start. All right, here's how we solve this. So, you have a couple of costs. All that you need to do is take future value of the cost and add them up. That's it. Add them up, not deduct them. So put everything on a timeline. Time 0. This is your 12 months. Spot price is 200. On top of that, right at the beginning, you'll have to pay storage of 6. Then somewhere in the middle of the year, 0.5 years, you'll have to pay insurance of 3. All right. And what you're going to do is take future value of this, future value of this, future value of this, and let's call them as A, B, C, and just add them up. That's it. Take future value of everything, add them up. Just give me the final answer. How much? 230.8. 230.8. Yeah, it's continuous compounding. Yeah, you're supposed to use continuous compounding. That's right. Is everyone comfortable with this? Easy? Okay. No, Silky says no. All right, Silky, ask. Raise your hand, ask. Why are you not comfortable? Do you want me to show you how to do this? Yes to show you how to do this, right, Silky? How to add this cost in continuous compounding rate. Okay, fair enough. Here's how you do it. 200 into e raised to, what's the rate? 10%. 10% into 1 plus 6 into e raised to 10% into 1, because we're compounding for the whole year, plus 3 into e raised to 10% into 0.5. Okay, so let's do this together. %, second e raised to x into 206. I'm just kind of being a little lazy here. to 27.66 STO1, and 10 percentage into 0.5 second e raised to x into 3.15, and then STO2 RCL1 plus RCL2 gives you 230.82. I have discounted to year 0. It shouldn't be done. No, you take the forward value. It's a cost. You want to add it. Take the forward value, add them up. Which components are we going to add? Which components are we going to subtract? Anything that's a cost, you're going to add. Anything that's a benefit, you're going to subtract. For example, typically in commodities, you get two benefits. You get lease yield. Lease yield means you have some commodity that you can lease out. Okay, generally with gold, but yeah, lease yield. And second, you get convenience yield. Convenience yield is what? It's like an intangible, the benefit of, correct. It's like an intangible benefit of having a physical commodity as against having a forward contract. That's called convenience yield. I calculated percent of cost and added it to 10%. Okay, fair enough. I hope you understood how to do this now. Would now discount back? No, Niket, no discounting back. This is not valuation of forward. We're not taking a profit and discounting backwards. We're just pricing the forward here. So there's no reason to take it back. Okay, all right. Ready for the next one, guys? Want to do a, what time is this? 7:30. Okay, let's do currencies. I can do cheapest to deliver now, but I think cheapest to deliver is best done at the beginning of the class because that's complicated. So we'll do it tomorrow. Right now we'll do currencies. Currency is easy because we've done interest rate parity at level 1, right? So do you want me to give you an easy one or difficult one? Easy dekhi khatam kar do. Okay. Let's take some exotic pair at least. At least that's the only fun we can have in level 2 class. Well, let's travel. Let's take some 2 really exotic currencies. Give me the wildest, weirdest name of a country. But also remember, something which is wildest and weirdest to us is someone's home country. Yeah. So generally CFA has a very, very low penetration in Latin America for the obvious reasons, right? CFA is a finance course. Those people don't believe so much in capitalism. So maybe we can take, which will come in exam. Okay. Mozambique, Tuvalu. Tuvalu is that small Micronesian island, right? Bahamas, Honduras, Malawi, Russia to Ukraine. Yeah, you talk about being weird. Karthik is here on the top of the list. Zambia, Nicaragua, Haiti. Okay, Bolivia. Do you think after Chinese crackdown, CFA in China will decrease? This is always random. Nityandas Kailasa. Do you mean that small country which was claimed? It's not an island, it's a piece of land, right? Okay, yeah, I think let's do Malaysia. It's not exotic, but it's fine. We'll work with Malaysia. And Malaysia, you want to convert with what? Let's convert. Malaysia is what? Ringgits, Malaysian ringgits with Singapore dollars. All right, so not at all exotic actually. So let's do Singapore dollars to Malaysian ringgits. All right. How many do we get? So, oh no, okay, that's because that previous number from this website is crazy. It remembers all your stuff. Probably this is larger than GDP of Malaysia. I don't know. Yeah, so Singapore dollar will fetch you 3.1652 Malaysian ringgits. Let's take a screenshot of this. Here we go. Now, interest rate in, should we do this in continuous? Just to kind of spice it up. So interest rate in Singapore, I don't know, but I'm going to make them up. Let's say 5%, continuously compounded per annum. Interest rate in Malaysian ringgit, so that will be MYR. Again, I don't know them. 11% continuous compounded. Right now, based on this information, you calculate 180-day forward price. That's an easy one. 180-day forward price. That's subpart A. Subpart B. Now listen to me carefully. Let's say you have a long position on 10 million Singapore dollars. Okay, under the forward contract, long forward on 10 million Singapore dollars. After 30 days, the spot rate is 3.4525. We can use up to 4 decimals. So you can use this 4 decimals here. Okay, so 3.4525. Interest rates have changed. So now the interest rate in Singapore is 4.25%, and the interest rate in Malaysia is 8.9%. Based on that, figure out value to this party on a mark-to-market basis. Okay, so you're going to need some interest rate parity, and then you should be able to pull this off easily. Start. You have 5 minutes, and I'm going to show you how to do this. Do you need something? Last question figure. I am too poor to read these numbers. We feel for you, Karthik, Kritik, ringgits, Taiwan, inlets. Do you think after the Chinese crackdown, CFA in China will decrease? That's an interesting question, right? Yes, interest rates are continuously compounded. Is the cricket match today, right? The fifth one started. Has it started? What are we batting or bowling? Oh, yeah, I know. All right, let's wrap it up then. Divyansh is getting 3.2615 as the answer. Full rain, Bangalore. Yeah, it's raining in Bangalore. How the match is happening in Bangalore, right? कैसे होगा match? What do you think of Hardik Pandya? He's wild, but huh? Yeah, yeah, yeah. It seems, but I like his attitude now compared to. I think he was aggressive for no reason, I guess. But I think that was also the case with Virat Kohli, right? When he started out, it was just aggression for no reason whatsoever. After becoming that, Karthik has a lot of inside information. Great without coffee क्या होता है? Oh yeah, that nonsense. Was it in Coffee with Karan? अच्छा, ठीक है. It's their personal opinion, right? Fitness issue, okay. ये आज का नहीं, ये अभी हो रहा है क्या अनुज? 3 ball 2 sixes. Oh, is it okay? Score, what's the score? Fifteen for 0. All right. Yeah, ये सिर्फ पढ़ाई का दिखावा कर रहा है. And I'll tell you a cool, should I tell you this? You wait for someone else to answer, then copy paste करके. Like every class, there are 1 or 2 sincere guys, right, who always get the answers right. आपको सिर्फ copy paste करके डालना है वापस. Okay, do you want me to show you how to do this? Are you getting answers, anyone? I need the answer for part B if you can do it. Your profit cannot be in SGD. Your apples are SGD. Yes, the Malaysian currency. 1.4180 million. How about you? Okay. I'm getting a few 2.4975 Malaysian ringgits. Darith has got 2.54 million. Darith, which currency? See, remember what I told you, when you're dealing with currency, we had some discussion in the currency class. Those of you not attended currency sessions, you can circle back to economics and have a look at them. But the denominator currency, we can think of them as an apple. Right? Don't think of it as currency at all. Just think of it as a commodity. Numerator is your price. So when you learn to think like this, the whole currency game becomes easier. Let me show you how to do this. And here's a funny thing. You don't even need to worry about continuous compounding formula. You can just use your simple interest rate parity formula. It still works. All right. So forward price is equal to spot price into 1 plus interest rate raised to n divided by 1 plus interest rate raised to n. That's your interest rate parity formula. Now, which interest rate should we put in the numerator? Price currency. Which interest rate goes in the denominator? Base currency, right? So let's say spot price. Spot price is 3.1652. So 3.1652. Now we have continuously compounded rate. So I'm going to say e raised to, instead of saying 1 plus r, I'm going to say e raised to, which is the currency in the numerator? The Malaysian ringgits, right? That's the price currency. So that's 11% for 180 days. So e raised to 11%, okay, into 180 divided by 365, divided by e raised to 5%. E raised to, that's the Singapore rate. So e raised to 5% into 180 divided by 365. That's it. Now, if you want to reduce your number of calculations, simple rule that our school teachers taught us, we have the same base here, right? So we can say into e raised to 11% minus 5%. When it comes in the numerator, it becomes negative in the exponent. So 11 minus 5% into 180 divided by 365, so that your number of calculations go down. It becomes a little faster. So the calculations will be 11 minus 5 percentage into 180 divided by 365. Second e raised to, oops, I pressed something else. Okay, 11 minus 5 percentage into 180 divided by 365. Second e raised to x multiplied with 3.1652. I'm getting 3.2602. 3.2660. I'm going to round it up because the next number is 5. So I'm going to make this as 3.2603 Malaysian ringgits, which is MYR for SGD. MYR for SGD. That's your forward price. Now, those of you who got this part right, give me a I pass on the box. Nice. I hope everyone, all of you got this right. This is easy, right? But good. Kuch to aa raha hai. Okay. Now, shouldn't be divided by 360, depends on what convention we're using. If the question says use 30 by 360 day convention or actual by 360, if the question doesn't mention anything, use 365, unless and until they've given you LIBORs. Then we use a different convention there. But anyways, LIBORs are going away now. So hopefully this part is clear. Now, the second part, easy. If you know how to think about it, it's very easy. Build a timeline. Time 0, This is 180 days. 180 days. All right. You have already entered into a position 3.2603 Malaysian ringgits is the price. You have built a long position. What are you going to buy? You're going to buy Singapore dollars. Singapore dollar is the base currency. Think of base currency as apples. Okay, easy. So how many apples are we going to buy? We're going to buy 10 million apples, right? So we will say 10 long position on 10 million apples. Easy. So we're going to buy 10 million apples. All right. Now what happens after 30 days? So after 30 days, so this is today. So after 30 days, the spot price is changed. What's the new spot price? The new spot price now has become 3.4525. So 3.4525, right? So what do? We call up the dealer and we say, you know what, can you please quote us a new forward price? So dealer says, okay, 3.4525 into e raised to, now I'm using the shortcut. Rates have changed, 8.9 minus 4.25. So 8.9 percentage minus 4.25 percentage. But for how many days now? 150 days, from 30 to 180, right? So 150 days divided by 365 days. So the dealer will give you a new forward price, which will be how much? So let's do it together. So 8.9 minus 4.25 percentage into 150 divided by 365 second e raised to x into 3.4525 equal to. So I'm getting 3.5191. 3.5191. Now, this is Malaysian ringgits per apple, per Singapore dollar. On the previous contract, you are going to buy apples. Now, on this contract, you're going to sell. That means you're going to build a short position. Remember, your apples are always the base currency. So if there's a trick in the question where, if I had said that you have a long position on $10 million Malaysian ringgits, okay, then obviously there is a contradiction because base currency is Singapore dollar, but you're building long on ringgits. You need to invert the quote and then do rest of the calculations the same way. So remember that whatever currency you're trading on, whatever currency you're playing on, make that as the apple in the currency code. That means put that as the base currency, then do usual calculations. So here, how to interpret this? 150 days from now, I'm going to buy apple at a price of 3.2603 ringgits. I'm going to sell those apples at a price of 3.5191 ringgits. Am I making a profit or loss here? Profit. क्योंकि मैं वो एप्पल क्या बोलते हैं सेफ मैं सेफ सस्ता खरीद रहा हूँ महंगा बेच रहा हूँ, right? I'm buying those apples at a cheaper price. I'm going to sell them at expensive price. I'm going to say Safarchand to apple in Hindi. That's with Pune people, right? Safarchand is Marathi. So 3.5191 minus 3.2605. 3.5191 minus 3.2605. How much? So per apple, I'm going to make 2.587 Malaysian ringgits profit. But remember, we are going to do 10 million apples. So if I'm going to do 10 million apples, then 10 million apples, and per apple, I'm making a profit of 0.2587. So this will be 2,587,000 Malaysian ringgits. That's my profit. But am I making this profit today or am I making this profit 150 days from today? 150 days. So last leg we'll discount them backwards. Now here's another trick, and this is where again a lot of people make mistake. If my profit is in Malaysian ringgits, I have to discount it backwards in the Malaysian interest rate. If you take profit in ringgits and discount them backward at Singapore interest rate, obviously you're getting a wrong answer. Good chance that wrong answer is one of the three options on the exam. That's why make a phone call method does not require you to memorize formula. You can simply use a simple logic, figure out where your profit is and discount at an appropriate rate. So here the appropriate rate will be the latest Malaysian rate, which is 8.9%. But I need to take present value. So it will be negative 8.9% into 150 divided by 365. Let's do this together. 8.9% negative into 150 divided by 365 second e raised to x into 2587000. That gives you Malaysian ringgits profit of 2494089.071. That's your final answer. How many of you got this right? 9. Even if you use 360, it wouldn't make a big difference. It will get you fairly close answer. Those of you who did this, congratulations. Those of you who did not, let me share the file with you. In fact, before that, okay, if Dinesh is asking what if I need answer in Singapore dollars, what do I do? Take this profit, convert this at today's spot rate. So just divide this with 3.4525. That's your answer in Singapore dollars. Yeah, it's same how we did in economics, correct. I told you when we were doing in economics that this part was going to repeat in derivatives as well, right? So it's going to be both ways. Can we see the results today? No. But can I give you the weekly test syllabus today? Yes. Weekly test. Are you in a mood to go aggressive or slow this week? Okay, if you want to go slow, let's only do derivatives. Let's do entire derivatives. Yeah, let's not do other subjects, just derivatives, okay? So we'll do entire derivatives. Total video content should be 25 hours, but I'm doing forwards, futures, swaps in the class. You do option videos. We work in partnership. Within a week, we can knock off derivatives. It'll be great fun. Are you up for a challenge? Come on, every now and then, you should do something crazy with life, right? This is your crazy this week. Imagine you can tell your kids the story कि 2022 में derivatives एक हफ्ते में करवाया था. पागल टीचर था हमारा. हाँ? Slowly बोल. My son is pre-teen. Thank you for sharing that information, Vinod. My kids are seeing this. मैं थोड़ा सीधा बैठ जाता हूँ. कर्नल साहब का लड़के देख रहे हैं. Can you share class notes from 13, 14, 16? Okay, I'll share them. What all do we need to cover? So here's what we do. See, with live sessions, we will cover your forwards. Okay. We will do futures, and I will be able to introduce you to swaps because I just have 4 sessions after this, right? So I'll be able to do 1 session on swaps. Thoda lamba kar lenge. But I don't think I'll be able to do swaps in depth. But we'll do swaps and self-study. you guys do the whole options. Now, remember, we have 2 weeks for derivatives. So I will have few more sessions to do options with you. So it's not that we're not doing options in the class. In fact, I need to record videos on options. So I will be doing options with you as well. But the whole idea is, this Parkinson's law, right? I don't know if you know it. The law says, if I tell myself I can do 10, I'll end up doing 7. If I tell myself I can do 20, I'll probably end up doing 17. Either which case, we're not going to lose, right? Push yourself. See if you can do it. If I was smart and if I was at your position, what I would do is start watching option videos tonight. After the session gets over, maybe after the cricket match gets over. If you sit the whole night, tomorrow morning, your options are over. Done. That's it. Okay. If not tonight, maybe do it tomorrow night. If not, get up at 3 o'clock in the morning, sit till 10, 11, go to office late for a day. Your options can be knocked out in single day. And then rest of the week, keep on catching up with forward, futures, and swaps. Done. That's it. Just ask yourself, what gets into you a day before the exam? A day before the exam, something happens, right? Imagine all the exams that you've written. जो साल भर पढ़ाई नहीं करते हो, एक दिन में कर लेते हैं हम लोग. Something happens a day before the exam. I remember my CA exams, BCom exams. Me and my room partner, we used to buy those sharp notes. Sharp notes आते हैं, सस्ते आते हैं. You get them 70 rupees. हम उतने भी पैसे नहीं खर्च करते थे. हॉस्टल में रहते थे, 70 रुपए क्यों कौन खर्च करेगा? So we used to buy one copy between both of us. और दोनों भी उसको खोलते नहीं थे. एग्जाम के पहले रात में दोनों को वही बुक पढ़ना रहता था. So we used to then tear them off in 2 parts. आधा. So then you first read the first half, I'll do the second half, then we'll exchange the copies, and then we will go and write the exams. And surprisingly, you used to end up doing quite well a day before the exam because you're valuing the time. Every minute is precious, right? You're not wasting any time. You're not checking WhatsApp, Facebook at that time. So imagine if every day of life can be like that. We can do much more, like exponentially more than what we can, do in our lives. So this week we'll make an experiment, just an experiment. We'll see if it happens. Push yourself, do whatever you need to do. Don't go to office, doesn't matter. But by the end of the week, all of us have to be really good with derivatives. Okay. So बस इतना ही है. Let me share this file with you. June. So there's one video with level 1 stops FRM. Can we watch? Yes, you can. कठिन परिश्रम. Yes. रोज मोटिवेशन दिया करो. मतलब आपको रोज गाली सुनना है. If we think in a way, we get to buy at a lesser of the two and sell at a higher, anyone would use arbitrage. How did you identify price and base currency? Okay. Price currency is the currency of the numerator. Base currency is the currency of the denominator. That's how I identified the currency. So it was 3.2 Malaysian ringgits per Singapore dollar. So 1 unit of Singapore dollar. So it becomes a base currency. Economics last class. Do you have the date for economics class? CFA level 2, I have filed for 15th. I don't have file. I think I must have misnamed the file. Can you check? This looks like the last one. What is the best way to revise level 1 derivatives in short time? You can watch level 1 crash course of derivatives on YouTube. I've shared the 15th one. Is that can you check if that's the correct one? I'll share whatever level 2 files I have. I think, see, we don't have the file for the last class because we were solving curriculum blue boxes, right? We were solving questions from curriculum on the last day, 16. That's why I don't have the file. I've shared the 15th one. 14th was an off. 14th was an off. I can share the 15th was an off. So 15th was an off. Then this 15th must be 14th. And 16th, there was no class. 13th, I don't have the file, sorry. 13th disappeared. Okay, जो है उसमें काम चला लो यार अभी. Or take screenshots from the videos because I don't have them. That's what I have. Would there be any revision at the end for level 2? You would get a crash course. I may or may not do a live crash course for August exams. November, I don't know. August nahi hai na? So August, we have level 3 exams. So I'll probably be, and level 2, I have recently recorded a crash course. It's very comprehensive. In fact, I've recorded 2 versions of the crash course. There's a crash course and then there is a crash course ka crash course. Because I don't know what got into me after finishing the crash course. I thought formula review karte hai. And then I started teaching and I went too much in details again. So I ended up creating one video which covers all the, but it's a full day video, total 12 hours or something like that. So if you watch these 5-6 videos, you would be very comfortable. Are the crash course available on the LMS? Yes. Under the revised section, crash course available. Summary videos and crash course are same? They're same. Okay, so crash course is within the summary videos. Will we get results tomorrow? Tomorrow, my last message to the app is a mess. Ignore my last message to the app. Will we get the results tomorrow? Yes. Tomorrow we'll discuss weekly test results. अब जाओ यार मैच देखो चलो. Thank you very much. I'll see you tomorrow, usual time.